Good afternoon, everyone. Today's Monday, August 15th, 2011, and we had some further follow through to the upside here. The S&P closed up 2.1%, and we did see diminished volume once again. So that is reason for concern always, but as we know, only price pays. When we get the market that has a huge decline like this, and we're going to usually get some kind of snapback rally like we're seeing in here. The question is, though, is this rally something that we can trust? Generally speaking, I don't think it is something to trust. That is, that we'll at least come back down typically and test those lows. We looked last week at the action of the S&P 500 in 2008, and that first real powerful drive lower had a huge rally, snapback rally that occurred just over the 2 days. Now, this one's maybe got a little bit better structure behind it, meaning that it's kind of settled in. We had that huge volatility, and as the quote goes that I like to say, I think from George Soros, is that volatility peaks at turning points and diminishes with the trends. But let's take a look back at this 2008 action once again. We had the huge snapback rally. It dropped off in a very dangerous way with this big gap lower. So we closed, we closed at this level and opened here the next day. But really continued to be volatile, and we did see what appeared to be and what people were calling a double bottom in there, but we had a sharp undercut of that, and it's still quite possible that we'll see similar action here in the S&P 500. For now, though, the buyers are in control, and selling short doesn't make sense. We're back above the rising 5-day moving average. Now, this thing could completely fall apart tomorrow, which is why overnight positions I think should be kept to smaller pieces. And there's in a week you might be saying to yourself, well, I knew that was the bottom, I should have held, or I could have done this, if it gets back up to this prior support near 126 where we broke down from. The fact is, no one knows exactly what's going to happen. We can come up with our risk reward ratio, and then the market might gap in another direction and completely destroy that. But right now, when we take a look at this large part of the decline, that is that real powerful leg lower, we've exceeded a 38.2% retracement, and if we were to get all the way to a 2/3 retracement, we would be up beyond the or right at actually the prior support here that we broke down from. That's possible. It's not a prediction. Manage the risk and see what the market gives us, and wait for it to change direction before you change your position, unless you're just going to cash. But we did close the gap from Friday, August 5th, right here, and that's, we closed at 120.08, I believe was the number. I wrote it down before. But we closed above that 120.08 level, and that's significant because that's when the news of the S&P downgrade of U.S. debt came, was that Friday after the close, and then of course we had the gap down and continued sell off, a bunch of volatility, and here's where we are today. So excuse me, we take a look at it. We broke past that resistance last week on Wednesday, and we've seen a grinding higher here. So we had a gap higher today, some pullback, and then as we regained the volume weighted average price again, that held as support. We ground higher into the close, and I was noting on Twitter that a lot of people are looking for this to fail. They're getting short, and that might be the case. We might have a big gap down tomorrow. I think you're better off going home in cash than having large long or short positions in this environment. It's still going to be tricky. Don't think that the worst is behind us, or there's not going to be further little surprises around the corner. The NASDAQ was up 1.5%. This market, as we know, moved right up to the prior support on Friday, and now we're up through that level. We're beyond in both of these markets as well. If we take a look back at the S&P for a moment, we're beyond that 10-day moving average. So it's possible we're going to catch up to the 20-day moving average. That 20-day moving average, of course, is declining. It'll come down at about this type of angle. So maybe it'll be near the 124, 125 level. We simply don't know. But we are seeing a nice snapback. And when we take a look at the NASDAQ, if we use this as an example of what's possible at that, what people are calling resistance. See, people were calling this resistance on Friday. And also we know it was prior support, which had the potential potential to become resistance. And today, no such luck. There was no resistance there. So it's a perceived level in an area of interest, as we talk about, not a level to take place. We broke the resistance in here at 53 last week and have been grinding higher in here as well. So, you start to see these markets break this pattern of higher highs and higher lows on the 10-minute time frames. That would be when you would want to start to maybe get a little bit more defensive with any positions that you do have and raise your stops. The Russell 2000 continued higher as well today, up 2.8%. So nice percentage move in the Russell, and this one came down a lot harder as well. If you look at where the bigger support was broken in here, up at that 78 level, we're still a pretty good distance away from there, and we're beyond the 10-day moving average. Again, all these markets diminish volume, and that's typically a sign that the buyers aren't super aggressive about chasing this. Maybe there's some shorts who are covering that sort of thing. But again, would you rather make $1,000, $10,000, whatever it is on big volume or light volume? It's all going to spend the same. You can't spend volume. You can only spend money, and price action is what that's all about. So the Russell 2000, again, we've got this pattern. It broke some resistance, and it's doing what a market is supposed to do. But it's difficult to trust. Just because we're above a 5-day moving average doesn't mean this thing can't fail miserably. We've got a declining 10, 20, 50, 100, 150, and the 200-day moving average is even flattened out. But with our oversold conditions, we're going to get these big bounces. So the theme here is, we've got to just be very cautious. What I had pointed out on Twitter as well was the IYR, which is the real estate index. And by the way, I don't think I brought it up. I meant to, because each Monday this show is actually brought to you by Realtick, which is the trading platform I use here. Realtick, I've got some questions recently asking about some free sites where people look at charts that are supposed to be real time, and they were noticing the big difference between what I was saying. Here's where a Realtick quote is versus what they're getting on that free platform. If you're trading, if you're in front of the machine every day and you're looking at a free website for your quotes, I think you really need to rethink what you're doing in terms of the tools. Realtick is a professional analysis and trading platform, and there are fees associated with it. But if you're working with a brokerage firm where you do a decent amount of volume, they usually eat the cost of the Realtick for you, and basically you don't end up paying the charge. So take a look into that. But anyways, back to the IYR, the real estate index trust. This ETF, not trust, but anyways, this ETF broke some bigger support. And look at the bounce we've had in here, though, is the point. From 49 up to 56. We've bounced 7 points, close to 15% here, just since hitting that low last week. And a 15% bounce, obviously there's a lot of opportunity in there, and we're not necessarily trying to get the whole thing. We're just trying to get some of the meat on that bone. And we've got this pattern of the higher highs and higher lows. If you're in it, you need to figure out where your stop will go as we start getting into this prior zone of support. This ends up becoming a potential level of resistance. It's only potential resistance. We'll know once we get up through there whether it is or not, or if it's like the NASDAQ and the NASDAQ just blows through that level without looking back and traps a bunch of short sellers. So again, the theme I think here today is more that we're bouncing after getting deeply oversold. We have lighter volume on this move. That's something to be aware of. That's part of the evidence that we need to consider. And it's difficult to trust these rallies like we saw in 2008. So continue to be reasonable. Don't be driven by greed and trying to think that you're going to make the entire move. No one does, and that'll do it. Thanks for tuning in.